Good evening, Marshall Reddick investors. Welcome to tonight's webinar covering how to buy investment property. My name is Garrett Stason. I am a real estate advisor here and a realtor. For those of you who are new to Marshall Reddick, this is a great webinar for you to get the basics and the fundamentals of how to go about researching specific areas, how to get started within. We haven't started yet. Oh.
Mm-hmm. The broadcast is now starting. All attendees are in listen-only mode.
Good evening, Marshall Reddick investors. Welcome to tonight's webinar. My name is Garrett Stason. I am a real estate advisor and realtor here with Marshall Reddick. Tonight's topic, we are covering how to buy investment property. So for those of you who are just starting out or have bought with us in the past, this is a great refresher for you to really get an understanding of how we actually go about evaluating markets, evaluating properties, what steps to take, who to speak with, and have coaching along the way. So this is going to be a great first reintroduction to you for tonight's webinar. All right, so I always like to categorize this slide into two different parts. So I always like to refer to the top section is really what we do here in California, and the bottom section is really going to cover what we do out of state. So Marshall Reddick, for those of you, again, who are brand new to Marshall Reddick or have been with us in the past, things have changed, especially over the past few years. So to give you an update as far as what we do here as a company, because we're here locally in Orange County, Newport Beach, we of course are a real estate broker, a licensed real estate broker. So part of my job is to help clients purchase their primary residence and or investment property here in California along on the sell side of that transaction. And we do that throughout all of California. We are also a private money lender. Those of you who cannot qualify for conventional financing, we do have options available to you here if need be. Third, we are a property manager. So Marshall Reddick is a property manager that stems from LA to Orange County, literally from Thousand Oaks, Burbank, all the way down to San Clemente and everywhere in between. That's really what we do here in California. Now the bottom section is going to be more familiar to those who used to be with us or who are familiar with Marshall Reddick. So outside of California, we have a network. I like to consider it as a team in each one of our designated markets. So the reason for that team is to really help you facilitate the transaction of purchasing or selling real estate in each of our markets the most efficient and easiest way possible. So we, of course, start off by having, our conversation here with me, getting you in touch with the right people, such as our designated agent, and then also property managers, and then the support staff along with it, right? So the CPAs, the insurance agents, and of course the lending aspect as well. Getting you in touch with the right people who we've worked with for a number of years, who know how our process works and knows everyone else that's on board for the team. So that is what we'll cover later, in more detail later on. Again, tonight's webinar, I'm actually going to be co-hosting this with my colleague and VP of Marshall Reddick, Scott Pastel. So Scott and I will be covering this webinar tonight for you guys. And just again, an overview of what Marshall Reddick does. We really just simplify the process of purchasing real estate, whether that be here in California and or outside of California. And all those services that I just mentioned earlier on really provides you with the quintessential one-stop shop mindset, right? So anything that you can possibly think of when it comes to residential real estate transaction, we're the right company to help you out with that. And again, we're built on the long-lasting principle of the buy and hold strategy. So Welcome to tonight's webinar, and we will get started here. So let me, before we get started, I'm going to introduce you to, like I said, Scott, who's our VP, and he will be covering the first half of this webinar, and then I will be taking over the second half. So Scott, you want to?
Yeah, thanks, Garrett. Hi, everybody, and thanks for joining us. Many of you have already probably talked to me or met me in the past. For those of you that I haven't had the pleasure of speaking to yet, really appreciate you joining us this evening. This is a presentation that has evolved over many, many years. This is one that we give live in San Diego, Orange County, San Francisco, San Jose pretty regularly, but many of you are outside of California, and we really do appreciate you joining us. I started working here about 12 years ago, and since I'll be speaking and covering some information, I think it's helpful for you to just see where I came from. And I am currently a licensed real estate agent, got my license in 2010, and have actually been using it pretty regularly lately as we have a lot more people looking to purchase or sell property in our local market. I graduated business school at Chapman University in 2006. Cannot believe that that was 11 years ago now. I had a recent alumni meeting this past weekend, and I just cannot believe how fast time flies by. I bought my first investment property in 2008 outside of my local area, far away actually, in Alabama, a place that I'd never even been to before, but I did a lot of research before purchasing it over many months, and many of that same information and research I'll be sharing with you tonight. Currently I own several investment properties, kind of scattered all over the place. I have a property in Phoenix. I still have property in Alabama. And I've done about 15 private finance transactions, funded first trust deeds, which is what Garrett mentioned, something that we do. So I've done many private money loans myself, and really love helping people get started and continuing to grow their real estate portfolio well into their retirement. And then Garrett will come back to his slide momentarily. So just to start, this is a overview of markets that our company has real estate teams and properties available in. We have selected these markets, and many of which we have actively been selling real estate in for well over a decade. In the late 90s, Dr. Reddick, who's now retired, started branching out of state and started building relationships with independent brokers, agents, and property managers. And he started with Phoenix, Arizona in the 90s, and in the early 2000s started making relationships with agents and brokers kind of all over the country. Marshall retired about 3 years ago. Ross Nelson and myself are the two current owners, and we've kind of scaled down a little bit, sort of consolidated the areas we're located. I mean, there's still 16 total, so it's still quite a few actually to be in, especially when we have property managers, agents, home inspectors, handyman contractors, the whole gamut of people in each market. As Garrett mentioned, our headquarters is located in Southern California. We also have an office in Northern California. We're a licensed California broker. However, out of state, we contract with third-party independent agents and brokers. So all these other areas outside of California, these are teams that many of which we've been working with for years and years that manage hundreds of properties. For example, Memphis, Tennessee, we've been working with the same team since 2001. They manage well over 500 properties for our clients. And many of these other areas as well, too. We've been working with the same teams for a long time. We've identified these markets based on our own criteria, which we're going to share with you this evening. I think it's important for you to take note on what makes a city, a neighborhood, a location, an ideal market to invest in, and why are certain areas and locations not ideal. So we'll be covering that criteria shortly. On Zillow, I suggest that you guys take a chance to go on there and look us up. We have, I think, about 130 reviews. You can see all of our past sales all over the country. Anytime you're working with a real estate professional, they should have a very well established Zillow page with reviews, with past sales. If you're working with somebody who's going to help you purchase one of the biggest investments of your life, I do think it's important that you verify their history and track record. So when you go on Zillow and you go to Agent Finder, you can type in Marshall Reddick Team. This is just a snapshot of Los Angeles and Orange County here in our local market. You can actually click on the properties. You can see the addresses, all the details. It's really helpful just to get an idea for the portfolio or track record of any real estate team. And all of our advisors, like Garrett, are also realtors, kind of have a quasi role here of helping people purchase locally as the agent or helping them buy out of state as the advisor. Yelp is also a great resource to use to do due diligence, and I share this with you because this is a big part of the due diligence process. Talk to so many people who have been working with an agent that they didn't really know, or maybe somebody referred them, and they're having a little trouble or they're a little unhappy with the process. And I asked them, did you do any research? Did you look up reviews? Same thing with property managers. A lot of people just, maybe somebody will give them a name of a property manager and that's enough for them. But I do think it's important for property management and real estate teams that you're working with that you do use Zillow and Yelp, since these are the two biggest resources in our industry. So here's a brief overview of what Garrett and I are going to cover over the next 45 to 60 minutes. We're going to start by going over how to set your investment criteria. This is the very first place to start when setting your goals and building out your next 5 years or 10 years in real estate. It really all starts with knowing how to identify your unique criteria. And everybody has a different criteria. Real estate is not one of those investments where somebody off the street can tell you to purchase a property in a specific market or a specific property and expect that that's going to be the best investment for you. So I'm going to be covering personal criteria to evaluate for yourself, to figure out what types of properties and what locations and what price ranges and what conditions make the most sense for you. After that, we'll be going over more methods of conducting due diligence, many of which are online. So many resources today. We'll be pointing out a few places to conduct research on markets, to evaluate the job market, the demand, the economic outlook, affordability, unemployment rates, vacancy rates. We're going to be going over all that stuff, and we'll share with you some websites to use. And then Garrett will be covering calculations and formulas to determine returns. That's one of my favorite parts. I find that there's really a very large discrepancy, I guess, of among people to figure out how to properly calculate returns. And I think there's a lot of loose terms thrown around. People say what monthly cash flow or cash-on-cash return, return on investment, but many times I find those people don't know how to properly calculate those returns and what numbers to use. So we're going to be covering that, very important part of the presentation. Then we'll be going over different options to use to purchase real estate. The methods of purchase are, it's probably about a half dozen or so common methods people use, from conventional financing to some sort of self-directed retirement account, or people like today, many of which are selling investment properties and doing a 1031 exchange to purchase more investment property and avoid capital gains tax. So Garrett will be covering the various options that are available and then helping you figure out which ones apply to you best. Obviously, looking at properties is nice, but it's important to figure out how we're going to acquire those properties. We'll be talking a little bit about insurance. We'll kind of be expanding out and covering the topic of asset protection. So we're going to be talking about property management and insurance and how those two components make up your asset protection portfolio. How you're going to be able to limit your risk as much as possible through insurance and through property management. Those two components are the largest of which to help you reduce your risk. So we'll go over property management as well, and whether you're purchasing a property 10 minutes from you or 10 hours or on the other side of the country, property management is essential in helping to ensure the continuous performance of your investment properties year after year. So we'll be covering some common mistakes people make, what is the sort of, I guess, makeup of a good property manager, what makes a good property manager good, and how to avoid, hiring poor property managers. And then finally, we'll be covering the locations that we showed you on our map. We'll be going into more detail about each of these locations and showing you areas that have the highest returns for investors. So getting right into it, let's start off with setting your investment criteria. So I would assume that a good percentage of you are currently using some type of financial advisor or wealth manager for some of your investments, whether that's a mutual fund you have, a stockbroker, the big ones like JP Morgan, or Schwab, thank you. Fidelity, most of you probably have a financial advisor, or you maybe have used one in the past. And from that very first point of contact that you had with a financial advisor, you might have started the conversation by asking them, what are the best investments for me? And without them really knowing who you are and all of the important factors that make up your criteria, they really can't give you any advice. A lot of people don't realize that real estate is the same type of system. Although, financial advisors can't help you purchase actual real estate properties, we treat real estate very much the same. So many people have said that our company is kind of like the Merrill Lynch of real estate. We help people evaluate their goals, their risk tolerance, their options, their time frames to direct them to the best properties possible. So the top of the screen, we have 6 questions. These are kind of like the main questions that any financial advisor would ask you. And many times, I know like Northwestern Mutual, I have a life insurance policy with them. And before I purchased that, the financial advisor I worked with sent me this investor profile. I had to fill out like 20 questions for them to figure out which investments make the most sense for me, right? My whole like matrix of where I should be putting my money. And they were really similar to these questions. When am I looking to retire? What's my current living expenses? What's my current earned income? What tax bracket am I in? So they're trying to basically figure out a mixture of 4 financial benefits. And they're trying to figure out, are you looking for tax benefits, tax write-offs, deductions? Are you looking for income? Are you looking for wealth building or capital appreciation or capital preservation, just to preserve what you currently have, right? So everybody is completely different. So at the bottom of the screen, you'll see the Reddick Property Rating Scale. Now, this can be applied to any property in the country. You can see from the left, luxury class, A, B, C, and D. Now, neither is actually better or worse than the other. What you'll notice on that scale is that when you're further to the left, you have higher priced properties, which with that comes along greater chance for appreciation and higher tenant quality. Further to the right, you have lower prices, you have lower tenant quality, but also the potential for more cash flow. Now, this scale can be applied to any major metropolitan in the country. And I'm going to show you the basis for determining property class in a moment. But when we stay with this slide right here, let's just pick any old city in the country. Dallas, Texas comes to mind. That's one of the markets that we're located in. You can find a combination of luxury A, B, C, and D in Dallas, just like you can in Los Angeles or Chicago or Tampa or Houston or Boise, Idaho. Any major metropolitan in the country has a combination of luxury A, B, C, and D. So which one is right for you? Well, I'll use an example really quick with my little brother and my father. And I'm sure some of you have heard this before, so bear with me on this. My brother now is 28. My dad just turned 70, actually. So my dad's retired. He was a middle school and high school teacher throughout the years and retired about 3 years ago. So he doesn't have his earned income anymore. Yeah, he taught, I think, for like maybe 15 to 18 years. So he has some pension, he has some Social Security, but those two do not replace the income that he was making when he was a teacher. So now that my dad's retired, he and my mom need to supplement the income that they were making from his employment. So his main investment strategy is income, whereas my little brother, who's 28, has another 30 plus years of working, doesn't have a family yet. His living expenses are very low, right? His health is strong, so insurance costs are relatively low. He doesn't have any auto debt. When you look at my father, he's got a lot more debt, right? He has he's a primary residence, got a car, health insurance for he and my mother. So my brother has a lot less living expenses, and he has earned income. So because my brother doesn't yet have the wealth that my father built over 40 years, my brother's investment strategy is A class. That doesn't mean that he's buying negative cash flow properties. He's just buying properties that have a small amount of income but a greater chance for appreciation. My father owns and purchases C-class properties. My dad's also had a little bit more experience, so he can handle the potential risk involved with C-class properties. So that's just a quick illustration of what types of properties appeal to certain people. All right, let's get to the next one. So as property managers, we studied hundreds of properties that we manage not just locally but also out of state. We spent about 2.5 years writing the book on our website called the Reddick Property Rating ebook, and this is actually just a slide I took right out of the book, and I wanted to share it with you on this webinar. So this is a trend that we noticed across hundreds of properties in over a dozen markets. So you can see at the top is just a sort of common theme among tenants in different property classes. So who are the people that live in or tend to live in different property classes? So you can see at the top, luxury class properties oftentimes are professionals within their industry. Perhaps they specialize in something. We see sometimes business owners. We like to call these career-oriented folks. A class, common to see a higher percentage of college graduates, mostly white-collar working professionals. We get down to B class, kind of in the middle. We see a combination of maybe either young adults, maybe high school graduates, mid-level managers, lower-level managers. When we get down to C class, this is usually like blue-collar, hourly wage employees. D class oftentimes are below the poverty line, Section 8 housing. A lot of that obviously is due to the purchase price, not purchase prices, but the rental amounts and what people can afford to live. So I'm going to be going somewhere with all of this, and I'm not just giving you these demographics just because they're interesting. This actually is going to apply to your bottom line and your net cash flow or your future potential appreciation when you buy a particular property. So to kind of summarize what I just said about the different demographics, basically the bottom line is that the higher the property class, the higher the job stability in most cases, right? This is like a rule of thumb. So you usually will see higher job stability, higher you go in property class, that can turn into lower potential vacancy for the person living in your property, right? If they're hourly wage and they jump around a lot, or they get let off or let go, then that's going to turn into a vacancy. Most likely won't be able to afford rent. So lower you go in property class, less potential job stability. Now, when we look at maintenance, how the tenants take care of your property. So the higher the property class, the higher the chance that the renters owned property in the past or plan on purchasing property in the future. That will lead to less potential maintenance. They've had a history of taking care of property, or they plan on buying in the future, and they probably have a little bit more experience or knowledge taking care of a house. And as you go down further the scale, C class, D class, these are usually lifelong renters that have no intention of buying property ever. So with that comes the potential that they may not care for the property quite as well as higher class tenants. So now, what actually causes a property to be an A, B, C, D class property? Now it says there down below the property classes, things that matter. You'll see the price points, the cost per square foot, the school districts, and the crime rates. Believe it or not, what really doesn't have much of an impact on property class is the age of the property, the condition of the property, the size of the property, whether it's a multi-unit, single-family, condo. It's really mostly due to the location. In luxury class and A-class properties, you're going to see a higher percentage of owner occupants in that neighborhood. B is kind of right in the middle. Maybe there's an even mix. And then C and D-class properties are located in areas that are almost entirely renters. And with that, obviously when you're in an area, you have a property that's mostly surrounded by owner occupants. Usually there's higher demand to purchase property in that neighborhood. Maybe there's better school districts. It's located, close to major attractions, and that helps drive the prices up in the value. And there's also more pride of ownership. And then in lower class properties, not as much demand to purchase there, so prices don't quite go up as much as the higher property class properties, and there's not as much pride of ownership. So at the very, very bottom, you'll see the outcome of what you can expect when you buy property in a certain property class. A, for appreciation, B, for a combination of both, and C, for cash flow. That's just an easy way to remember the difference between property classes. So neither is better or worse than the other. It's just better or worse for you or the next person. So one of the pages in the Reddick Property Rating ebook, and towards the end of the presentation, we're going to share with you how to download this ebook for free. It's about 40 pages directly on our website, also on Amazon. Garrett's going to show you where to download that if you haven't read it yet. I highly, highly, highly recommend it. It's a short read, maybe an hour at most, but it's going to give you a lot of information that you'll be able to apply. So one of the pages in the ebook, I took another snapshot of it, is this map. And this map is hyperlinked to the National Association of Realtors website. So if you click on it in the book, it'll take you directly there. And the National Association of Realtors has been tracking the quarterly home price appreciation and the median home price in every single metropolitan market in the country for the last 25 years. So you'll see there's all these little green houses on that map. When you click on it, you can click on any of those houses. It represents a particular metropolitan market, and with that you can find the current quarterly median home price as well as the last 25 years. So this data is the basis for determining property class. So wherever you're planning on buying property, or wherever you currently own property, or wherever you're planning on selling property, in order to determine the property class, you have to know the current median home price. And obviously the median home prices fluctuate all over the country, right? The last time I checked, the U.S. median average home price was somewhere around, I think, $260,000 or $275,000. And here, in our local market of Orange County, the median home price is, I think, about $750,000 now. San Francisco is about $1 million. So if the median home price is $275,000 in our country, that means that there's locations that have lower than $275,000. So this exercise and taking 15, 20 minutes on this website will blow your mind just to see the difference between median home prices all over the country. What it'll tell you is that there's no such thing as the real estate market. I get that question all the time. How is the real estate market? What do you think the real estate market's going to do? And my follow-up question is always, which real estate market? Which one are you talking about? Because LA is different than Orange County, that is different than San Francisco, then is different than Cleveland, Ohio, then is different than Minneapolis, Minnesota. I mean, every market is performing differently. So once you understand, once you know the median home price in whatever market you're looking at purchasing or trying to determine, then you use the following scale. So this scale is also in our ebook. You'll find it all over our website. And we studied hundreds of properties to come up with this scale. This scale is accurate so much so that sometimes it's scary to really understand property classes. So the top scale is for single-family detached homes. The bottom scale is if you're looking at purchasing a multi-unit, something, duplex, triplex, fourplex. So we've adjusted it slightly for multi-unit properties. But if we're looking at the top scale for a second here, and let's go back to Dallas, Texas, and the median home price in Dallas is somewhere around $200,000. I think it's a little higher. Let's just 240. Oh wow, it went up. Okay. All right. Well, let's just say that it's 200 to make this easier. Okay. So the median home price, as Garrett pointed out, is about 240. Let's forget that for a second. Let's just take any town USA and say that the median home price in that market is 200,000. So we know that because of the percentages we see on here, the subject property we're looking at, we have to divide that into the median home price. So if we're looking at a property in any town USA for $100,000, we know that that's 50% of the median, if the median's 200, and that's on the border of C and D class, right? If we're looking at a property that's anywhere from 50% to 80% of the median, it's a C, 80% to 100% of the median, B, median up to 1.3 times the median is A, and a property worth more than 1.3 times the median would be considered luxury class. So why is that important to us still? So this is all interesting stuff, but what does it really mean? What's the bottom line? So once we know the property class of whatever property we're evaluating, we'll have a much better idea of the potential maintenance and vacancy. See, this is the unknown. And all those slides bring us to this slide right here. So in the past, investors have struggled with determining how much potential maintenance and vacancy they can expect on a property. Now, anybody can figure out the mortgage that they'll be paying. If they're using financing based on your down payment, based on your loan amount, and based on your interest rate, and based on the term, whether it's a 15-year or 30-year, you can easily find out what your monthly mortgage payment will be. Property taxes are all public, so that's very easy to obtain online, Redfin, Zillow. We can get the property taxes. We go to the county website. Insurance rates, we can talk to an insurance agent. We can send them the address, answer some questions. They'll be able to give us some quotes on the property. If the property is in a homeowners association, we can determine easily what the monthly or quarterly HOA dues are. When we're hiring a property manager will tell us what their monthly rate is, 6, 7, 8% of the monthly rent, whatever they charge. But that's usually where people stop. So they take the monthly rent, they subtract all those expenses I just mentioned, and they're left with a number that they think is the cash flow. However, they look back at their property, let's say 2 or 3 or 4 years later, and they're like, well, the cash flow is a lot lower than what I expected, and my returns are lower too. I had some months where I didn't have anybody living in the property. I had months where I had to fix some of the appliances, repaint the property. So the goal here is to determine our long-term cash flow, our long-term ROI before we even purchase a property. So after all the studying that we did for several years across hundreds of properties, we noticed that the properties that we were managing, as well as all the teams that we manage, have fluctuating rates for maintenance and vacancy. And we also noticed that higher property classes experienced lower maintenance and vacancy. So the percentages that you see on the screen here are meant to be used in your analysis, and are also, you'll see at the bottom of the screen, percentages of the monthly rental amount. So let's just take another easy example. Let's say you're buying a house and the conservative rental expectation for that property is $1,000 a month. So when you're determining your monthly cash flow before buying it, you would subtract $80 a month for maintenance and $80 a month for vacancy. Now that confuses a lot of people. A lot of people get confused by that because they think that they have to pay $80 a month for maintenance and pay $80 a month for vacancy. It doesn't work like that, right? Vacancy is not an expense. Vacancy is just a loss of income. You're not going to pay vacancy, right? And maintenance, it certainly does not work out the same amount every single time. You could go months and months and months and months without maintenance, and then you have to fix a condenser, replace a coil in an AC unit, or you have to repaint the property, or you have to fix the garbage disposal. I mean, there's all different things that could happen, right? So these percentages are meant to be used for pure analysis to give you kind of the average long-term monthly cash flow. Now, a quick example for vacancy. This is a practical example to give you a better idea for what these percentages mean for vacancy. So if you take a percentage, whatever property class you're looking at, and you multiply it by the number of days in a year, that's going to give you the number of days in that year that you're subtracting for vacancy. So 8%, if you're buying an A-class property and you're using that percentage, you're factoring in, I guess what you're doing is you're expecting to have 30 days every single year without any income. So this is a very conservative example when you're calculating your returns. I hear people all the time throw around these very unrealistic rates, like 3% vacancy rate, 4% vacancy rate, and they get confused by the media or real estate professionals telling them, well, right now at this very moment, there's a 6% vacancy rate in our town, and that's such a loose number, right? Is that 6% in the entire metropolitan of Austin, Texas, where there's over 1 million people living there? There's obviously going to be some zip codes that maybe have 2%, some zip codes that have 12%. How is that going to relate to your property, right? Even if wherever you're buying property has a low vacancy rate, your property might have a lower or higher vacancy rate depending on the price that you ask for rent, how well it's advertised, the professionalism of the property manager. There's so many factors that can lead to vacancy. Obviously, the main one is property class. So those percentages will give you a better idea of how many days you're allowing for vacancy every single year. And again, you might go 2 or 3 or 4 or 5 or 6 years without any vacancy, but we know that real estate investing is a long-term investment. And we're using these examples on about a 10 to 15 year projection. So if you buy a property, a rental property, and you sell it in 3 years, these percentages are not going to be accurate. These are only accurate over a long-term 10 to 15 year hold. So we have our very first poll question, and so it's an anonymous poll, so we're not going to share any names. Very helpful for us to kind of take a pulse on the audience here. We have a lot of people on the webinar, and some fun poll questions to ask. So let's see, let's hide that. I'm going to put up the question in just a second. I'll give you guys about 10 seconds or so to answer the poll. Okay, so the first question is, which property class, A, B, or C, appeals to your investment goals the most? Are you looking to build wealth and have a small amount of income from real estate? Are you looking for maybe an even combination of appreciation and cash flow? Or are you looking for mainly cash flow? You don't really care about the values going up and you're just strictly looking for income. So we've got a lot of you answering. Oh, and by the way, if you have no idea, that's totally fine too. You can click unsure. So we'll give you guys maybe about 5 to 10 more seconds to answer. We appreciate your involvement. We're going to share the results obviously anonymously so that we have a better idea for what the majority of people are interested in. Okay, we have about 80% of you that have given an answer. So I think that's 82. All right. Okay. All right, guys. Let's go ahead and share the results. So, not too surprising, I guess. A lot of people are looking for a combination of appreciation and cash flow. And I know this question is difficult because, are we asking this for just one property or is this every property? Many investors are looking at purchasing one property every few months or every couple of years to build a portfolio. So obviously some properties, I've seen people purchase A class and then a B class and then a C class property. But I guess if you can only buy one, that's kind of what this question pertains to. So yeah, thanks a lot, guys. So 59% said both, 15% said appreciation, 22% said cash flow, and then only 4 are unsure. So that's a small percentage, actually. Go ahead and hide that. All right. So let's continue with the presentation. I wanted to share this with you. Now, I can obviously talk about this for like an hour. I'm not going to do that. Don't worry. This is the process from start to finish. Once you sign a management agreement, with a property manager, what happens next, right? So you buy a property. Let's just say it's vacant when you buy it. You've already hired a property manager. The next step is to get the property ready for advertising and place a tenant as quickly as possible. So once you close escrow on a property, that property now you have title to, it's your property, the property manager can now start advertising it. So the very first thing is the property manager, and this is what we do here locally and what our teams do out of state, is first going to want to visit the property. So either they'll drive to it, they'll get a better idea for the condition of the property, and they'll walk through it and tell you if the property needs anything at all to get rent ready. Maybe it's missing a door handle, or maybe one of the appliances doesn't work, window screen is missing, it doesn't have maybe the proper smoke alarms, smoke detectors. So they're going to walk through it with a cosmetic eye, also an eye for making sure it's up to code, up to the building code and the state code. And they'll tell you if the property needs anything at all to become rent ready. Maybe it just needs a cleaning, and that's it. So they'll give you that feedback, and they'll also tell you on step number 2 what the fair market rental amount is for that property. So a lot of times people go on Zillow and it'll tell you this property can rent for $2,400 a month, but that's not always going to be accurate. So a property manager will do a rental market analysis, and that includes a property manager using the local MLS. They use the local multiple listing service to look at what like-kind properties have rented for in the area. So they should hopefully be looking at properties very close by, maybe a half a mile, maybe 3/4 of a mile at most, and properties that have rented within the last maybe 3 to 6 months at most. They're going to be looking at properties that have the same bed and bath mix and helping you figure out a range for the rent. So sometimes a property is very easy to determine, and they know without a doubt this property is going to rent for $1,000 a month. Maybe your property has some upgrades, some unique features, a bigger lot size, and they'll tell you, well, this property could rent for $3,000 to $3,200 a month. And then you need to decide if you want to be on the competitive end and get it rented quickly for that lower end of the rent range, or hold out longer for a higher amount. So it's kind of just what your temperament is on doing that. You'll sign a management agreement with your property manager that spells out all their duties and responsibilities and the services and the fees that they charge. So you actually have a formal contract with your property manager. Those contracts are usually a year. Most of the time they'll renew at expiration unless you cancel. And then's the onboarding process. So property manager is probably going to need your banking info if they're going to direct deposit. They'll need you to fill out a W-9 so they can send you a 1099 during tax season to report your income and expenses. They might send a request for your insurance policy. So just a few documents that they might need from you. If there's any of those additional little repairs, little cosmetics needed, property managers got handyman, contractors. They can do any of that work if it wasn't already done during the escrow process. Let's say you bought an as-is property, right? You're going to probably need to do a little bit of work to it before renting it. Once all that work's completed, the property manager is going to send out their photographer. Hopefully they're going to do a great job. Like we have a professional photographer, turns on all the lights, opens the windows, has a tripod, takes great photos. Hopefully you have, let's say 20 or more photos in your ad. If you have a smaller property, let's say you're buying a home in the Midwest that's 1,000 square feet, 3-bed, 1.5 bath, you may, maybe 12 pictures is fine. But larger the property and the more unique features, the more pictures you want. And then they're going to place the ads on all the major websites: Zillow, Realtor.com, Trulia, HotPads, Craigslist, anywhere they can, anywhere where people look for properties. I always like, if you're hiring a property manager, I think it's important to go online and review the ad once it's up. Make sure you like the photos. Make sure you like the description. Make sure it captures everything accurately. Trust but verify is the expression that we use here. Then once the ad is live, then comes the showing. So the property manager places the ads. Now they get all the phone calls and emails sent directly to them, and they're going to start scheduling showings. Now our leasing agents here in our office ask a number of questions to those potential applicants. When are you looking to move? Who's going to be living in the property? Why are you moving? And then, so then assuming they get the answers they're looking for, the property manager or the leasing agent actually will schedule these showings. We like to do at least, hopefully, 5 to 10 showings, if not more, to turn into at least 2 or 3 applications. Once a property manager gets applications, they're going to do all their background checks. So step 9 is, they're going to call their employer, verify their employment. They're going to call the recent landlords and, verify their renter history. They're going to do a criminal check, make sure they don't have any felonies. They're going to do a credit check, make sure they don't have any bankruptcies, judgments, foreclosures, evictions. They're going to look at all those potential red flags. If an applicant passes the property manager's screening and background process, then the property manager then shares the necessary information with the landlord. It says, hey, we got an application. We already ran all our background checks. They passed our process. Can you give us our blessing? Are you comfortable with these tenants? And sometimes, maybe they have like 2 pets and the owner only really wants 1 pet. So it's kind of like they'll discuss that situation and figure out if the owner is comfortable approving those applicants and signing a lease. Once an applicant is approved by the property manager and landlord, then the property manager provides a lease to the tenants and signs it, and then gives you a copy. And on the date of move-in, the property manager will conduct a move-in inspection or move-in evaluation. So they'll walk through the property with that new renter, and they're documenting the condition of the property. They're taking pictures, and they're filling out a report that you get a copy of. That way you know the exact condition of the property, and the tenant and property manager know the exact condition of the property when the tenant moved in. Because eventually when they move out, a year or two or three or whenever, the property manager needs to go back to that move-in inspection to figure out the condition. That way they can deduct any damages, any negligence, any items that should be taken out of the security deposit. And there's no argument from the renter. The renter can't say, well, that wasn't there when we moved in. Well, yes, it was. Here's the picture. Here's the notes. Here's your signature on the move-in evaluation. So this is all stuff that a professional property manager will do. And I'm getting a feeling that at this point you're realizing the value of having a property manager for a very small percentage, very small fee. Many property managers like us will offer a mid-lease inspection 6 months into the lease. If the owner likes, we can just, we can schedule a visit to the property. We give the tenants advance notice. We'll walk through the property, make sure they're taking good care of it. We'll send that report to the owners. And really what this does, it sets a precedence for the renters that they know ahead of time that there's going to be a move-in evaluation, or not move-in, a mid-lease inspection or evaluation. Sets a precedence that they know they have to take good care of it because somebody's going to be in that property halfway through to take a look. And then finally, when the tenants give their notice and they move out, the property manager does that final walkthrough and compares it to the move-in inspection and gives back whatever of the security deposit after any cleaning and damages that were done, while the tenant lived there. Okay, now I know I spent some time on that, but that really was an important part of the presentation. So you have an idea for how property management works, how important it is. Next, we're going to talk about how to choose where to invest. So all the locations that we shared earlier, Phoenix, Arizona, Las Vegas, Dallas, Houston, Austin, Cape Coral, Florida, Memphis, Tennessee, Indianapolis, Indiana, all those locations had to fit into our criteria in order for us to have teams there and for us to provide those locations to our investors. We're very, very, very picky about the locations that we offer to our clients, and a lot of our staff own and purchase properties in these markets as well too. So essentially, these are the 7 points that we look for in any market to invest in. Not every city, not every state in the country makes sense for investing. So first, we got to look at the job market. We want to make sure that we are located in an area that has a high job growth rate, very business friendly, a lot of major employers moving there and setting up new locations there, and lower than national average unemployment rate, because this type of demand is going to impact the rental market and the real estate market. So jobs bring all the renters and all the owners, right? So if we know that the job growth rate is increasing, which we pay attention to, we know that we're in an area that is probably going to see an increase in rents and purchases. Now that tends to have an impact on the current vacancy rate. Now obviously you're going to have different vacancy rates based on your property class, but an area that's adding jobs and lower than national average unemployment rate, business friendly, it's typically going to be a lot easier to rent out. Now that's going to apply in year 2, year 7, year 10, year 20. For however long you own a property, we study the economic outlook well into the future, not just today. Economic diversity. So is there a wide array of industries in that market to support rents and to support values? Then is it affordable? Is this a market where the median home price is at or below the national average, right? If we're going to be buying investment property, the numbers need to make sense. So we have to look at the affordability rate. Is the state in which we're purchasing property landlord-friendly or tenant-friendly? Are there any local universities and colleges to support the future job markets? And then finally, can we find reliable property management? We're going to share with you some websites in a moment that you can get a lot of this data, but essentially you want to make sure that you have all 7 of these things wherever you're buying, and all the markets we're located in checked off these boxes for us. So here's an article that recently came out about Dallas. We see this a lot in Dallas, San Antonio, Austin. Texas is the most business-friendly state in the country and adding the highest percentage of jobs every single quarter. Last year, I think it was about a year to 2 years ago, Toyota announced that they're shutting down their Los Angeles headquarters and moving to Dallas, Texas. About halfway through the article there, it says at least 4,000, perhaps as many as 5,000 employees will work at the $300 million facility west of the Dallas North Tollway. And that's a huge number of employees from just one company. But Toyota is not the only company that has been moving to Texas. And we saw Liberty Mutual recently adding 5,000 jobs to the Dallas market. FedEx opened a new headquarters, adding 1,500 jobs to Dallas. This particular location is in West Plano, which is still part of the Dallas Metropolitan. But this is the trend that we're seeing because of the affordability, the low regulations, the low taxes, the strong workforce. So a lot of people are moving out there. This is great when you own rental property in an area like Dallas. So this pie graph we're looking at was taken from the U.S. Bureau of Labor Statistics, and it's a website that tracks the monthly unemployment rate. And if you go on the U.S. Bureau's website, you can type any city in the country, and it'll give you the employment mix by industry. It'll tell you the percentage of jobs in different industries. Now we can see that the biggest industry here in Austin, which is the office and administrative support, is only 18% of the overall job market. Now, that's a very, very safe percentage, right? Because if we look at a city and we see that half the jobs are in one industry, we know that that is a very risky place to invest. And Austin obviously is the state capital of Texas, huge metropolitan market, over 2 million people live there. So in a large metropolitan market, we're more likely to see a diversity of employment. But if we're in a small town, 2 hours away from the nearest downtown, we're probably going to see like agriculture or manufacturing or something that just dominates the job market. That's one reason out of many to stay away from small towns. Stick with large metropolitan markets. Now, we're going to share with you where in a given metropolitan makes the most sense to buy. But our theme has always been to stick to buying in major metropolitan markets, but in the suburbs of those areas where you can tend to find families, better schools, newer properties. And that's really the overall theme is buying in the suburbs of a major metropolitan market. You get to benefit from the demand while buying in an area that maybe is just a lower crime rate, newer properties, better demographics, better school districts. I recently went on Google and I just typed Austin, Texas unemployment rate, and that data actually pulls directly from the Bureau's website. But last I checked, Austin had a 2.5% unemployment rate, which is half of the U.S. average. So this is an example of an area where it's just seeing incredible demand for rent and purchase. So that's a very, very good sign for a market. It's a very, very, very good outlook for a place like Austin that has such a low unemployment rate. Another market that we're very, very active in is Cape Coral, Fort Myers, Florida. This is southwest Florida, about an hour and a half to 2 hours south of Tampa on the west part of the peninsula. Cape Coral is just constantly in the news. This is a Forbes article. Cape Coral's got a lot going for it. It's interestingly enough the Boston Red Sox training facility. They do have an international airport. Hertz Rental Corporation has a major headquarters there. And it's not just a tourist destination. They do have a very strong job market. But it's an area in Florida where you can still buy your average single-family home for maybe around $150,000 to $200,000, a 5 to 10-year-old home. And because the rental market is so strong, this city in Florida is still producing a lot of positive cash flow. You can't find that in Orlando or Tampa, Port St. Lucie. A lot of places in Florida you can no longer find cash flow, but this is kind of our diamond in the rough. So Cape Coral was recently named #2 in the 10 hottest real estate markets for this year. All right, so Garrett's going to take over, and he's going to do my favorite part. He's going to go over the calculations and formulas for investors.
Awesome.
Garrett?
Thanks, Scott. He always does a really good job explaining property class, so I hope you guys have at least a good understanding of the property class and really what our goal here is to really just give you the proper expectations when evaluating property for the future. So I know you guys have other things to do tonight besides just listen to the webinar. family, friends, especially dinner, right? So I will keep this as short as possible for the remaining, I don't know, 15, 20 minutes or so, and then get you guys going. So how do we actually calculate each investment? So we're looking at appreciation. For those of you who don't know, it's the highest return on your investment. And the other thing that most people look at when evaluating property is cash flow. Cash flow is your highest cash-on-cash return. So when evaluating markets, this is going to be on every single one of our properties that we have on our website, right? We're always going to have the appreciation trend. Scott touched upon it briefly. We get all of our data from the National Association of Realtors, and it'll show you the appreciation history over that time frame. And you can see each market's going to be different. Some markets tend to fluctuate a lot higher than others. Some markets rarely fluctuate when there are downturns in the market. So that's another part of the evaluation process that I go through along with my other advisors here, is really figuring out your risk tolerance to see what you're comfortable with. So here's just an example of a property that we will, that we have on our website that we can, go through all the financials with you, right? So everything on your right-hand side is going to give you the all the numbers that we have laid out for you. Everything is over at you can see at the bottom, over a 20 or a 15-year history. So of course, under the picture, you'll see just the basics as far as what property class it is, when it was built, bedrooms, bathrooms, square footage, which is great, right? And of course, if it has been rented or it is rented, it'll give you the description of the current rent status on that. But to give you an example, we'll always look at the list price first, right? These are all going to be factored in on the interactive calculator that we have. So what I mean by interactive is you can always change these numbers, right? You can always change the list price. You can change your down payment. You can change your initial repair cost. So to make things simple, we'll look at this as an example here. So this is how we really calculate your true numbers for you over the 15-year. You have your list price, and then we, of course, calculate 25% down payment, any initial repair costs, and really what that is the agent is going to estimate what it is, how much you're looking to put into a property to get it, quote-unquote, rent-ready, to get the highest possible rent dollar amount. We factor in closing costs, of course, as well. We actually have a formula for that on our website. Anytime you see the function symbol next to a specific tab, you can always click on that, and it'll give you our calculations and formulas and how we come up with that. So all in all, to get into this property, it's about $48,000 initially to get started. Hopefully, if you do this right, that's the only dollar amount you will be allocating towards this property for the remainder of your existence with this property. So the rent, if we already have a rental amount plugged in to the property, that's really a median of the high and the low amount for what you can get. So of course, our property manager in this particular market is going to run a market analysis on this for you. So essentially what this is saying is you can get anywhere from, $1,375 to $1,425 for this property. We will be right there in the middle as far as a conservative level to give you an estimate. We calculate your mortgage payment for you. Of course, your taxes, your insurance, your management fee is going to be included in there as well. If there were or are any HOAs, that will be in there, and then utilities and landscaping is mostly covered by the tenant. So of course, we break all of that down for you to get your total monthly expenses. So after everything you've paid for, all of your necessary expenses that you have to pay in order to keep this property, that's going to be a total of $952. So after your rent minus your monthly expenses, you will have a monthly income of $442. Now, back to what Scott was saying earlier with property class and what we allocated, what we want you to consider is taking out percentages for vacancy and maintenance. And then, of course, the leasing fee, which I'll get into in a second. So take out 10% for maintenance, 10% for vacancy. That money is still going into your Wells Fargo, B of A account, whatever you have, that money is still going to you. Same with the leasing fee, right? So the leasing fee is what a property manager charges to replace a new tenant in a property once your prior tenant has left. And we factor in about every 18 months or so, over a 15-year time frame is when you can expect that to happen. So we just break down 50% of 1 month's rent over 18 months. Take all of those out. What your net is really going to be $125 as far as the cash flow. 15-year projected profit, and then ROI. So how do we come up with those numbers, right? Great questions. How do we calculate ROI? Profit from sale divided by your total cash invested divided by the total number of years. Pretty simple, right? But how do we come up with the profit from the sale? How do we estimate profit from the sale? So like I was saying, you will see this in every single one of the properties on our website that you actually click on, and right next to the total projected profit is that function symbol which I was explaining to you. And this is how we calculate total projected profit. It's your accumulated cash flow plus your appreciation plus your principal paydown minus any selling expenses. So to give you an example, this is based off of that Florida property that we just went over, your accumulated net cash flow. So we're actually taking the cash flow that you receive after we take out vacancy and maintenance, times that by 12, times that by 15 years to get your accumulated net cash flow. Appreciation, how do we calculate appreciation? That's always going to be there for each individual metropolitan from the National Association of Realtors that has the appreciation trend for each market. Then we have your principal paydown, what your tenant has paid off for you over those 15 years. And then we factor in selling expenses. So about 9%, 3% to the buyer side as far as the commission, 3% to the seller side, and any closing costs we allocate 3%. Now that 9% could be 7%, could be 8%, but really to give a conservative number for it, we like to allocate 9%. So simple math right here. You add up those three minus your selling expenses, and then you have your profit from the sale, right? This is all showing you once you actually sell the property. So now this is all the total cash invested, which is everything that we just went over on the front page. So the profit from the sale divided by your total cash invested over the number of years you've held the property, which happens to be 15, is 18%. If you have any questions on this or you'd like me to go over with you in more detail, I'd be happy to do so. I'll provide you with all my information at the end of the slide or presentation here. Speed things along, we're going to go through the exact same thing, but just in a different market. So Memphis is one of those markets where it really tailors for a cash flow oriented type tenant. As you can really see, the price points of Memphis are going to be a lot lower than the national average, which in turn will give you higher cash flow. Same thing which I just went over, you have Memphis and then you have Florida, the exact same numbers that we use as far as what we're factoring in for each of those numbers. So now that we're going into a cash flow oriented market, how do we actually calculate cash on cash return? It's going to be your annual net cash flow divided by your total cash invested. So your total cash on cash is going to be 7%, and how we came up with that was the dollar amount that we come up with every single month after we factor in our expenses, our maintenance, our vacancy, our leasing fee, and then divide that into what we actually initially put in to purchase this property. So a really cool feature that Marshall Reddick developed over the past few years has been this interactive calculator. There is a section on our website that goes into everything I just talked about that'll spit out for you cash flow, ROI, for any number you want to put in. It's a blank calculator. You can go on Zillow, on Trulia, find properties that you have interest in, and just for the fun of it, figure out if I were to get it for this price, or if my down payment was this amount, or if I only factored in X amount for vacancy and maintenance, or my interest rate was this amount, what is my total ROI or cash flow going to be over 15 years? Another really cool thing with this calculator is we have multiple options for you when evaluating it, right? And what I mean by that is, how are you going to be purchasing the real estate? It's going to most of the time be defaulted to conventional financing, but you can also have the options to do cash purchasing and or private financing. So I highly recommend you looking on and playing with this calculator. And again, if you need help finding it, I will certainly point you in the right direction. Okay, so there are, of course, many different options when it comes to purchasing real estate. Every single person that I speak with as far as an investor has a different method, has a different financial situation, different places in life to pay for property, right? So I'm going to cover briefly all of these for you here. So conventional financing, doing a home equity line of credit or a cash out refinance is another option. If you have more than 10 mortgages, or you are self-employed and you write off a lot and you don't show enough income, you may not qualify for conventional financing. What options do you have? Such as private financing. You can actually pay for property through a self-directed IRA, which some of you may know, some of you may not know. Of course, cash, and then also a 1031 exchange. So to get quickly started, before we get into that, I want to do the second poll here, and I'm going to show you what method of purchase do you plan on using when purchasing property. So those are the ones that we have listed for you. Is it going to be conventional financing? Is it going to be cash, private, 1031 exchange, or are you looking to purchase through retirement funds? So I'll give you guys about another 10 seconds or so. We've got about 50% have voted, so I'll give you guys another few minutes on that. Or sorry, seconds. All right, so I'm going to close this poll here. So about 60% of you are looking to do this through conventional financing, about 5% cash, 14% private, 5, 1031, and 19, which is through self-directed IRA, which is great to see. Again, this is really showing you how many, each person is different, and you have to take a unique approach to that. Okay, so we're running out of time here, and this is all important stuff, but I really want to get towards the end. And this is what I do here as far as a consultation. So all of this, if you have questions on it, I would love to speak with you. Let's find a time to do that over the phone, over email, or come into the office. I'd be more than happy to sit down with you to go over this. But this is just kind of a basics of what you can expect to find with conventional financing. And of course, this is all going to be recorded. So if you like a recording of this, I can send you the slides or send you the recording of this, okay? Some things to consider when evaluating, or what lenders look to evaluate debt to income. What's included in debt, credit card loans, auto loans, mortgages, what's not included, healthcare, cell phone bills, utilities, stuff like that. Here's just some basic numbers as far as debt to income go. Really anything above, a 700 mid FICO score is really going to get where you're going to get your best rates. How to choose the right lender, extremely important, right? You want to make sure that they have, of course, a strong presence on Yelp, Zillow, but you want to make sure that they're a direct lender. What I mean by that is they do everything in-house as far as the processing, the underwriting, they originate their loans in that building. This is very important too, because you don't want to be dealing with 5 other people, and you don't want to have 5 other hands touch your loan and packaging your loan when making one of the biggest purchases of your life. So to go into this very briefly, we work with Reed and Al. They're located right down the street, essentially here, if you're familiar with Orange County, down in San Clemente. We've been working with them for close to 13 years now. They've done over thousands of transactions with us. They're licensed in all of the states that we're located in. So, if you I highly recommend, at least if you already have a relationship with someone, at least getting you in touch with them to run quotes for you, and then also really have your process run extremely smooth when putting in offers is going to help your process and your opportunity of purchasing a lot greater. So can't qualify for conventional financing, like I just mentioned. Here are some. This is going to go over private financing and kind of what we look for here with Marshall Reddick. Since we are a private financing, we have a private financing division, right? So these are all things that I can talk to you about. If you'd like more information on this, I can get you in touch with our underwriting team here as well. Self-directed IRAs. Again, this is a conversation that we can have one-on-one to really figure out, does this make sense for you? Because there are rules, there are regulations as far as what you can use and how you can use an IRA. Insurance, of course, is going to be another big protection as far as your liability when purchasing property. Stan Dreckman and Michael McAllister are just like Reed and Al in a sense that we've worked with them for a number of years. They're licensed in all of the states that we're licensed in. So when looking to find the best quote and getting a really good indication or accurate quote for a particular property as far as insurance, they know what to look for. They've done so many properties with us. They'll know what to look for, what questions to ask when evaluating and protecting yourself through the power of insurance. I'm actually going to, skip most of these slides. We just, again, suggest at least a $500,000 minimum when it comes to limited liability protection coverage. It's really going to cover all the basics of your property in case of an emergency. So I can certainly get you in touch with Stan and the team once we get down that route. So again, this is something that Scott covered earlier on in a little bit.
I can jump on really quick on this one, Garrett. And folks, sorry we're going through these slides a little bit quickly. We just want to make sure that we cover everything in the necessary amount of time. We are recording the presentation, so everybody on the presentation tonight will get a copy tomorrow. We're going to email you a link with the recording. Some of the slides that we had to go through quickly just now, you'll be able to get all the details for. So sorry about that. We just want to be mindful of time. Property management. So here are the main things to look for when selecting a property manager. We obviously are a property manager, so putting this together, obviously we put the things that we fit into. But since we're all investors, many of our staff own rental properties, and we do have property managers that we've hired out of state to manage our properties as well as our clients. This is kind of our selection process for choosing a good property manager. The very, very top starts with their online presence. How modern is their website, and are they taking advantage of all of the websites out there to advertise properties on? Usually a property manager's website is an indication of how successful they are at advertising property online. Over 90% of renters in our country right now find properties online. That was a statistic from the Apartment Owners Association recently. So very important that you're working with a modern, somewhat innovative company that knows where properties need to be advertised. And their website is going to be a good indication of their ability to do that. Now, if we go to the right, if we're going clockwise, is there a maintenance conflict of interest? This is probably one of the most important things to be aware of when selecting a property manager. Is the property manager that you're using, do they have an interest, do they have ownership in a maintenance company, and do they require you to use that maintenance company? I have seen time and time again property managers that make most of their revenue from maintenance and a small percentage from the fees that they're collecting from the management. Huge conflict of interest. When it comes down to it, your property manager should only be making money when you make money, and they shouldn't be making money when you lose money. So a good example of that, Marshall Reddick hires third-party independent contractors and handymen. They're not on our payroll. They've been vetted. They have licenses. They're insured. But any expense, any maintenance cost that's not caused by the renter, right? If the renter causes it, obviously the renter pays for it. But if it's normal wear and tear and the landlord has to pay for it, whatever that expense item is, that money goes directly to that handyman or contractor, and none of it goes to Marshall Reddick. Right? And that's what that type of property manager that you want. You want a property manager that isn't making money from your maintenance. Huge conflict of interest. We keep going down. Cost versus service. What's more important to you? You're going to have to ask yourself that question. You're going to see varying fees from 6, 7, 8%, maybe even higher, and you're going to have to determine, is cost what's most important to you, or is value and service what's most important to you? So you really want to look at the Yelp reviews, the Zillow reviews. If you really, really, really want to do as much due diligence as possible, maybe request a few references. You can talk to other landlords that have worked with them in the past. Ask all the right questions. Make sure that you have a very responsive property manager, which brings me to the next one. You're probably going to have a few phone calls or emails back and forth between that property manager before you hire them. If they're responsive, if they're answering your questions, if they're providing you detailed answers, and you're getting a great service already, that's going to be an indication of how they're going to treat you and the renter once you do start working with them. So that initial communication at the very beginning is indicative of what's going to happen after that. So are they responsive with you before you've hired them? If they're taking a long time to get back to you, find somebody else. Next comes online reviews, which I've mentioned already. And then finally, cancellation policy. Read the management agreement. Figure out if there is a cancellation fee. I consider that a red flag. If a property manager is charging you all these fees to cancel, trying to lock you in, something isn't right. So you should have a very open, flexible policy. Property manager like us doesn't charge any cancellation fee. We require a 30-day notice, but other than that, there's really no fee to cancel. So make sure that you're reading your management agreements. Make sure that it makes sense to you. The other thing that I consider a red flag is a property manager charging a management fee during a vacancy. There's actually property managers out there that will charge fees even when the property is vacant. That right there is an example of a property manager making money when the owner is losing money. So anything that fits into that, ask yourself that question. Are they making money when I'm losing money? And that means find somebody else. Yep. Right here, go ahead.
Cool. So these are the markets. We already went over the slide. Each one of these, which again Scott covered, fit into these 7 pinpoints or criteria, things that things that we evaluate when finding a large metropolitan. So each one of these is going to fall into these 7 categories. So last poll question before you guys head off. Okay, of the states Marshall Reddick is in, which one am I most interested in? California, Texas, Tennessee, Florida, or any other? So I'll give you guys about 10 seconds or so to complete that, and then would love to share some of the results with you guys. All right, we've got about 80% that have voted, so I'm going to close this poll. All right, so we have about 31% in California, 31% in Texas, 8% in Tennessee, 8% in Florida, and 22% in others. So, yeah, that's great to see, people's preferences as far as where they'd like to be moving forward. So, okay, moving right along. This slide right here is a market data package which you can find online. You can download a PDF. These are going to cover each one of the markets that we're in. It's a really good detailed pamphlet, really, that has graphs, charts, demographic numbers, job numbers for each one of these markets. And I highly suggest that if you do have an interest in one of the markets that we're currently in, take a look at this and just check it out. It's going to have a lot of good, useful information in there, and I'd love to chat with you more about that. Okay, so every risk has its, or every risk is involved when evaluating or taking the next step for an investment, right? So let's start at the bottom, right? These are really the 4 main risks that people always think of when purchasing property. The natural disasters, property values going up or down, am I buying too high, maintenance issues, and vacancy, right? Natural disasters is always going to be covered if you have the right insurance policy, which is, again, getting you in touch with the right insurance agent who knows the area, who's going to give you the best policy for that particular, for your particular home. Property values, right? By putting at least 20 to 30% down, you're going to ensure yourself at least some positive cash flow. So if you're worried about buying at the top of the market,
let's just hide that. There you go. Sorry, guys.
Oh, I'm sorry about that.
Oh,
yep.
All right. You want to just
go
over again? It looks like that might have gotten blocked.
Yeah, sorry about that. So when it goes back to making investments, there's always risks involved, right? So these are the four main ones that most people have when evaluating property, right? You have your natural disasters, but again, like I was mentioning, when you have the proper insurance coverage, that's going to eliminate that part for you. Property values. By putting, a decent chunk of your down payment, it's really going to help with your positive cash flow. So, if you do happen to buy at a time where it's at a height of a market and there is a correction, you're still going to be receiving that positive cash flow, right? And again, your goal is the long-term buy and hold strategy. So if you hold on to it and you don't sell when there's lows, just like your stock advice, right? You want to buy low, sell high is always the motto, right? But when you don't do that and you buy high, you don't want to sell low. You want to ride that out, and you want to, again, evaluate your risk and how much of that you can take on. Maintenance issues, Scott covered this a lot as far as, property management has a lot to do with eliminating some of these maintenance issues, getting the home inspection, right? So we didn't cover this yet, but it's the same process of buying a home with us here as if you were buying your primary down the street. We, of course, want to do all of the due diligence and take the necessary steps to protect yourself. So when you do put in an offer and we're in the escrow process of a property, we're going to be ordering home inspections. And you, myself, and then the agent that we work with are going to be evaluating the home inspections to see what we need to cover, what the seller needs to cover. So that's also another benefit of using our agent in each of those markets. Another way to eliminate maintenance issues is to buy newer construction and then, of course, purchase turnkey. For those of you who don't know what turnkey, the term means is really a company going into a property and fixing it up, for whatever needs to happen to make it rent ready, whether it be, replacing the HVAC or, the roof, and making it all livable for tenants to occupy. Finally, vacancy, right? The higher the property class, the less vacancy you're going to have. Sticking to large metropolitan markets, right? Just like Scott was mentioning, we really don't want to be 2, 3, 4 hours outside of a large metro where there's a smaller population of those looking to rent, and of course the job market entailed with that. And then finally, which we've touched upon at least 5 times, is property management. Make sure you have a property management team that knows what they're doing, because that's really going to be the driving force behind your success and those real numbers when evaluating property. So I carried away with myself here, but if you're doing all of your due diligence and protecting yourself and taking the necessary steps to purchase real estate, you really should be feeling like this at the end. And then Scott can kind of take over from here, but if you don't know who Scott is, this is Scott in his property.
That was years ago, though. I don't have that beard anymore. But yeah, that was a day that I had right after I closed on one of my properties in Phoenix that I was obviously very happy about. This was the 4th property I made an offer on back then. This was several years ago, and I had my criteria down. I didn't visit this property until I closed on it. I had our realtor, who we still work with, driving properties, sending me all the details. I'd plug it into the spreadsheet, the one that similar to the one that we have on our website. The one we have on our website now is way more advanced, but yeah, it was a really good feeling, and this is what we want each of our clients to look like, after they work with us. So that's our goal, to make sure that you're happy as I was when I purchased that property in Phoenix. We're going to email each of you tomorrow with a link to the recording. But in that email is going to have the direct link to download the Reddick Property Rating ebook. You can find it on our website, marshallreddick.com, under the Invest tab. And like I said, very, very, very educational, no fluff, just all actionable, really valuable content. And I highly recommend you guys read that. And our website, if you haven't been on our Learn page, is an entire online school for real estate investing. You've got over 100 videos, you've got over 100 articles, you've got calculators, tools, really anything you need, kind of just at the comfort of your home and your computer, all for free. There's no subscription, there's no pro version. All the content we provide, including this recording, is going to be on our Learn page, marshreddick.com/learn, or you can find it directly by clicking the Learn tab at the top of our website. And you can see on the left all these different categories: videos, articles, guides, calculators. You can type in that search box anything you're looking for: asset protection, insurance, property management, cash flow, whatever it is that you're looking for and you want to learn more about, you'll find on our website, on our Learn page. And then working with an advisor such as Garrett. So we do not charge for any of the education, none of the consulting. All of that is complimentary. We are a real estate broker, a lender, and property manager, so we make our money service-based, not fee-based. And you guys have the opportunity to talk to Garrett after this presentation. And that process is going to kind of look like this, this wheel here. Garrett's going to help you determine your why, your how, your when, your what, your where, and your who. So we kind of covered this tonight. He's going to help you set goals for why you're investing in real estate, what you're looking to accomplish, how, so what options you have available to you, what's the best time frame, depending on your job situation or whatever's going on in your life. Maybe you're still saving up, so when is the best time for you to invest? And maybe that's now. So he's going to help you identify timing. Then he's going to help you set your criteria. So our advisors like Garrett do all this for you, one-on-one, hands-on, helping you define each one of these. And so for what, helping you determine your criteria, A, B, C class, where, what markets make the most sense for you, and then who, introducing you to all the key players, our realtors, our property managers, our lenders, our contractors, our building inspectors, just kind of plugging all the pieces together for you, because honestly it's hard to get started investing in real estate when you're on your own. You don't really know who to work with, you don't really know what steps to take, you don't know what direction to go. 30-minute phone call with Garrett. He'll help you plug some of these pieces together. And then from there, it's just really communicating when you're available. You're busy, everybody's busy, so it's kind of just setting up phone calls and emails back and forth until we help you, not just purchase your first property, but for years and years and years, helping you through that process to grow your portfolio and eventually maybe sell your portfolio or will it to your heirs and, help you accomplish those long-term goals. Garrett, if you want to kind of give them the information here.
Yeah, so thank you all for taking the time this Wednesday evening. I know you guys all have a life outside of real estate. So just to quickly touch upon, well, first, if you'd like a consultation, of course, you can visit, marshreddick.com/consultation. And then this is all of my direct information right here below. You can email me the best time and day that works for you. And then, of course, or just give me a call. So again, thank you all for joining us tonight on the webinar, and I hope to hear from you guys soon.
Happy investing, everybody, and thanks for joining us. We look forward to talking to you directly. Have a great night.
Thanks.
Bye.